Hi there and welcome to ET Now. I'm Ashwin Mohan and you're watching Amicus Curiae, where we get you news and views from the world of corporate law, tax and regulatory affairs. And this week we're going to take a closer look at the first board meeting that was presided by the new man in charge of market regulator SEBI, Ajay Tyagi. Now, what we're going to do is we're going to take a look at some of the key takeaways from this first and very important crucial board meet, which ushered in sweeping reforms not only in capital markets but also in the commodities segment. And to throw more light on some of the steps and proposals that have been approved by SEBI, we're joined by Gupta, former ED of SEBI and founder Stakeholders Empowerment Services. Mr. Gupta, thanks so much for taking out time and joining me.
Thank you, Ashwin.
Always a pleasure having you on the show. Yeah. Let's start with one of the major decisions that was taken by Mr. Tyagi as part of his first board meet. And this one, of course, was regarding mutual funds. Now, even the previous, even his predecessor, Mr. Sinha, has complained about the fact that mutual funds do not have sufficient penetration and they wanted money to move to this segment as well. What SEBI has done is that they have allowed new investment and redemption routes in mutual funds, and investors can now instantly redeem liquid mutual funds up to rupees 50,000 a day or 90% of the folio value, whichever is lower. What kind of a impact do you think it will have on the market scenario?
See, you have to see that this step is going to make mutual fund akin to a savings bank deposit for a limited purpose. Up to 50,000 rupees, the mutual fund can be operated as a savings deposit. Now, the impact of this would be that people who hitherto were not investing in mutual fund because it was locked in, and if they had a liquidity issue, they would not be investing. So, probably that class of people will be coming in. But everything, when it is a positive, it has a negative also.
Sure.
SEBI has mandated that you will not be allowed to borrow for this. You have to keep sufficient cash for making payment under such circumstances.
How will this be detrimental?
It will be detrimental because on that portion of cash, the mutual fund will not be earning that return which is available on investment. So, a marginal loss would be there. Say, for example, if they keep 5% or 10% of AUM under liquid and the cash, so that cash will not be earning 8 or 9% return that they would be envisaged. So, but it is again, it is a choice of the investor that if you want a liquidity, invest in this. And the second SEBI has done in this only, that only these liquid funds will be allowed such redemption and no other funds will be allowed. So, those funds which were doing this, their return would marginally increase because they will not be keeping such liquid funds in their portfolio. So, I would say that everything has a positive and negative, and this fulfills one demand of the investor class, that my fund should be liquid, and this liquidity has been provided.
Mr. Gupta, what do you think prompted SEBI to provide this route of instantly redeeming liquid mutual funds? What were the scenarios which coaxed the market regulator in this direction?
See, I would really not know what was there, but I would say that when you look into the objective of investment and what should be the parameters of investment and what should be the quality of investment, so you look at many factors, and liquidity and instant liquidity is one of the factors which many people would look forward, and especially the small people. So, in order for bringing a small people also who would want to keep 40,000-50,000 rupees safe in the bank because they can withdraw anytime. So, this is one method of doing it.
Before we move on to some of the other takeaways from the SEBI board meet, the new chairman has taken over and he seems to have taken over with a bang. Many of the legacy cases of the past are slowly approaching their fruition. These are cases which are pending for a long time, be it the entire probe in the case of RIL. Recently we are given to understand that SEBI has also issued final show cause notices against brokers in the NSCL scam. So, a lot of the legacy cases which are pending for a while are slowly being addressed. How important do you think it is for a regulator to avoid long pendency of cases?
See, I would not really go into a specific of any case, and I would not go into how this would happen, but very clearly there is a maxim which says that justice delayed is justice denied. So, it seems that SEBI is going to work on this thing and say that anything which comes to them should be disposed of as fast as possible in the shortest period of time, so that anybody who has to be punished should be punished. Anybody who is innocent should be freed of all the liability as soon as possible. Otherwise, what happens? Uncertainty remains and the reputational issue happens.
Sure, point taken. Now let's get back to the board meet. And in the board meet, sticking to mutual funds, the government is really aggressively pushing its entire Digital India campaign. And there's been a lot of focus on e-wallets. Now what SEBI has done is, SEBI has also allowed investors to use e-wallets to buy mutual funds of up to 50,000 per financial year. And analysts believe that this move could potentially increase inflows into India's 18 trillion mutual funds market. What do you have to say about this, SEBI, moving in line with the government's policy of making consumers, investors more digitally conscious?
First, it is a good step forward, and secondly, I do not see it as any different, because it is just another mode of payment.
Okay.
You have mode of payment through a draft, you have payment through RTGS, you have payment through broker. So this is one more thing, and it is a little bit more seamless as compared to any other mode of payment. It is instantaneous, you can use through a mobile and everything, and I think it is a step in right direction. How much it will be having an impact or not, we will have to see, but all these efforts will have to be substantiated with the efforts of mutual fund industry.
Sure.
To increase its reach and convince people that mutual fund is the right vehicle for investment, even if it is as small as 500 or 1,000 rupees, that could be there.
All right, sir. Now let's move on from mutual funds and also look at public offerings. Now what SEBI has done is that they've also tightened the initial public offering norms, and in this direction, SEBI has definitely gone ahead and come out with a few reforms. Now, if one were to look at the entire IPO process, people from the industry have been demanding some changes to the entire IPO process. And keeping in mind these changes, what SEBI has done is that they have in fact taken steps to ensure that funds raised are not misused, because that has been a concern of the regulator in the past, that whatever funds are being raised, perhaps they are not being used for the reasons that are mentioned in the IPO prospectus. Your thoughts on this?
I would say that on one hand, every player in the market complains that SEBI is making more and more laws and making their life difficult.
Okay.
But I would request them to introspect that why SEBI is forced to make more and more laws. It is their failure which makes SEBI to make more laws. Had industry not been misusing, or had all the players in the industry were playing their role properly, probably this move would not have been required. I believe that chartered accountants are the first gatekeeper for interest of everybody in enforcing the law. If they give certificate, if they monitor this, probably SEBI would not have been required. But it is the failure of collective system. Then the SEBI is forced to make the law, and earlier it was up to 500 crore, now it is 100 crore. Now who pays the cost for this? The cost is paid by investor again, because whatever is the monitoring agency appointed, that cost for that agency will be paid by the company, ultimately by the shareholders. So my opinion is that the shareholders should now really take up the case and tell the chartered accountants and company secretaries of the company that please be independent, act independently, and if there is anything, report it properly. Probably all these requirements will not be there and law requirement will be less. That is where the problem is, that on one hand we blame SEBI that you have put more and more laws. On the other hand, we are ourselves responsible for forcing SEBI to make laws. No lawmaker wants to make many laws, but it is the situation that demands.
It's because of the mischief in the market that SEBI is forced to come out with these regulations.
And I tell you, it is not that only one person is mischief, it is the collective. That the chartered accountants do not do their work properly, company secretary do not report it, even the audit committee does not. So my point is a collective failure of the system.
Sir, but you and your firm, you bat for investors. What's been the response to this particular move? So far, I know it's still early days.
See, the response is anything which protects the interest of the investor, I am for it. But then I am saying there is a cost for it. And the cost is caused not by investors, not by me or not by SEBI. It is by the people who are manning the thing. If the audit committee plays their role effectively, if the board plays its role effectively, chartered accountants play the role effectively, why SEBI will need to make such laws?
All right. Now, sir, let's move on to the commodities market. And in the commodities market, there's, this is a move that was widely expected. It's definitely going to benefit some of the players, who have high trading volumes in the commodities market, say the likes of MCX. And this is a move wherein SEBI has given the green signal for options contracts in commodity derivatives. How revolutionary do you think this move is? Or do you think this is a move which was long delayed and finally has got the signal?
See, I would not say it was long delayed, because the products and complicated products in the markets are introduced depending upon the maturity of the market and its participant. Now, if you look at the history of commodities market, it is not very old, it is hardly 15-year-old history in the market. So, probably it is maybe little early, little late, it will be a subjective issue. But the other thing is this, that when you have decided that there has to be a commodity market, then you should always introduce instruments which will cover all possible methods of trading or taking exposure in market. So, options is one of the two. Having said that, this is a positive mood, I would say that one more thing is this, that the education is very important for using of these products, because many times you find that many of the people, investors who are led to garden path by brokers or by advisors from people, without understanding the product they invest and then they cry. So, my situation is that yes, products are good and it is a good step. Simultaneously, the entire industry will have to educate investors so that investors are not taken for a ride.
And also, I feel with the integration or merger of Forward Markets Commission with SEBI, SEBI also now has a responsibility to oversee and come out with measures that deepen the commodities market, right, sir?
I would not like to use the word also. It is SEBI's responsibility. Why also is something like a stepmotherly treatment. It is a major responsibility of SEBI to take care of commodities market, to take care of securities market, and SEBI is probably doing its best on that way.
I spoke to a few players in the commodities market, sir, and they believe that this step to allow options trading, they believe that this will complement the existing future contracts and also further bolster the price discovery process in the Indian commodities market. Your take?
So, as I said, that it is the entire bouquet of products is available. Now, it is expected, because theoretically everything leads to price discovery in exchange market, but we have seen that many a time there could be some sort of a manipulation. So, SEBI will have to be cautious about the manipulation also, and you have seen in past SEBI has taken some action against price manipulators. So, it will continue. So, this game of regulator and people who are trying to cheat would continue lifelong. It is not going to come to an end.
Also, another aspect, sir, is that they have also amended the stockbrokers regulation so that they can integrate stockbrokers in equity and commodity derivatives markets, basically coming out with a unified license which will allow the same entity to operate in both markets. I mean, this provides a great deal of flexibility, don't you think so?
I would say it is a very good thing. On one hand, it reduces the administrative load of SEBI. Secondly, it reduces the administrative load of compliance load of brokers. And third, it is a very positive that if you have done wrong in one segment, you cannot say that I am not wrong in the second segment. If you are bad, if you are a bad egg, you are a bad egg. So, this will give a good thing to SEBI, that if somebody has done something wrong, because today it is a situation that if you have done something wrong in the securities market, you still continue to operate in commodities market.
Absolutely.
So, I think that thing will go, and it is positive from all perspective, whether it is administrative for broker or SEBI or regulatory for the SEBI.
And some believe that it will also reduce the cost for financial intermediaries, right?
I would say this will be only possible once the clearing corporations are integrated. It will not be possible with the two separate clearing corporations for commodities and securities, because they will not be on the digitally talking to each other. They will be talking digitally to each other only when some sort of a interoperability is introduced in the clearing corporation.
All right. Now, I know we had touched upon the misuse of IPO funds earlier, but here's a small aspect also which I think deserves attention, and this is wherein SEBI has made it compulsory for companies to appoint a monitoring agency
Yeah.
if their capital market issue size is more than 100 crores. Earlier, the floor was 500 crores.
Yeah.
I mean, I'm not too sure what kind of a monitoring agency this will be and who will be part of it, but SEBI expects this monitoring agency to submit their submit the report every quarter now, and companies will have to publish this, on their websites and inform the exchanges. What do you think could be the contours of such a monitoring agency?
I think you are missing one more thing.
Yeah.
The SEBI has also said that this report would have to be commented by the board as well.
All right.
So the responsibility is cast upon the board also.
The fiduciary responsibility.
The fiduciary. Now the monitoring agency, I really do not know, but I think it will be some form of chartered accountant or something which will be doing it.
But so the selection of the monitoring agency again is key.
No, the selection.
Who are the people who will be part of it?
Selection, I do not know. I do not know internally what will be there, but it will be on an objective criteria basis. It will be done. But I would say that it is one more layer for oversight.
Okay.
Whereas if the first layer had not failed, second layer would not be required.
It's a form of self-regulation also to some extent.
Yeah, because I would very simply say that when I invest in a company, it is some sort of a contract. And if the company is not following that contract, they are in the breach of contract. Of course, because being a securities market, laws are different, but I would say it is a breach of contract between the two parties, that you took money from me for objective A and you did not do objective A, you went for objective B. So it is a breach of contract.
All right, sir. On that note, we'll have to slip into a short break. Our analysis of some of the key takeaways from the new SEBI chief's first board meet continues on the other side. Stay tuned and keep watching Amicus Curiae. Welcome back to Amicus Curiae, where we are discussing some of the key takeaways from the new SEBI chairman's first board meet. And the next one, of course, Mr. Gupta, is on the entire bad loan issue. And here is wherein the regulator has relaxed some of the criterion for banks and financial institutions. And this, of course, relates to the relaxation concerning preferential allotment to deal better with the bad loans issue. Now, just for a background, typically companies cannot make preferential shares of, preferential allotment of shares to any entity which has sold their shares during the 6 months preceding the issue date. But many banks somehow found themselves on the wrong side of this regulation when they had to sell shares of companies whose bad debt they had to convert to equity. Now, this criterion has been relaxed, and SEBI is also now sort of getting into the mode wherein it's trying to make life easier for banks who are struggling with the NPMS. Your take on this particular move, sir, and this relaxation?
See, I would say that we have to realize that NPAs or bad loans are threat to the entire banking system, and every effort has to be made to ensure that the disease does not spread any far. But one thing I would say, that the concept in the public mind is that all bad loans are because of bad decisions or because of diversion of funds. It is not a case. Many of the bad loans are because of the environmental issue, because the economy has changed, the competitions have changed, so markets have changed. So we have to distinguish between the two types of bad loan: NPAs which are genuinely NPA because of the business issues, and other NPAs which are because of the personal or integrity related issue. But whatever it may be, the money is money. If there is a loss to the banks, it is a loss to the banking system. And if the NPA problem is not addressed properly, probably it will be a, some sort of a issue of faith in the banking system. So every agency has to work. So entire ecosystem has to support the bank to get over this problem. And SEBI is part of that ecosystem of financial market, and SEBI has to do everything possible to ensure that what if the bank wants to take any action, the SEBI regulation should not become an impediment into their path unless until there is some really anti-minority related issue. But I would say that since banks are not related parties, banks have no personal agenda. So whatever they may do, it will be for the ultimate benefit of the company. Now the minority investors have two choices: one, let the investment go down the drain, become zero, or let them go some of their rights and let a chance be given to the company to revive. So I think the second option is always better, and that is how, based on that logic, SEBI has relaxed all those regulations.
But if you look at the relaxation relating to preferential allotment, do you really think it will make a difference on the ground? I mean, if you are a bank, would you be cheering this move?
I would be saying that one doesn't know what is the number of such instances.
Okay. Yeah.
Because, say for example, the problem of NPA would be in those companies where the shares are not doing very well. Now, if shares are not doing very well, shares are quoting below par or much below the value, probably the bank would not be selling it unless until, because of the Chinese wall, the investment department of the bank could have sold some share as a policy or something, where the department which is dealing with the restructuring of loan would not be aware.
Okay.
So probably this could be the instances. Otherwise, you will not find many instances where on one hand bank is selling it and they don't behave like the private entrepreneur to encash this thing. I don't think. And secondly, it will be foolish for them to sell at 2 rupees or 5 rupees below par and then subscribe at 10 rupees or more. So I don't think it will be the common thing. But yes, it is a enabling provision and it is a right provision.
Enabling provision and a right provision.
Yeah.
Now, Mr. Gupta, we have had a look at the capital market reforms. We've had a look at the commodity market reforms. We've also now spoken about how SEBI is also helping its fellow regulators like RBI to deal with NPMS. So we have dealt with most of the issues and the crucial aspects of the SEBI board meet. But you're somebody who's a corporate governance veteran. Going ahead, are there any aspects or areas where you think the market regulator should pay more attention to when it comes to two aspects? A, corporate governance, because we've seen a lot of that embroiling India Inc. in the last few months, and two, minority shareholders.
See, I would say that it is not a exam like course where you have to complete this course. No chairman or no person would be able to do all that is possible, because everything gets evolving. So you settle one problem, tomorrow the next problem surface. So that will be always a challenge for this. But I would say that based on my experience of almost 5 years doing this, some of the areas where SEBI will have to really start is one I have seen in the mergers and demergers. Many times valuation reports are there because that is mandated.
Sure.
But valuation report do not convey anything to the investor.
Okay.
Second thing is in merger and demerger, a company gets listed where the investors have no clue what are the assets and liabilities of the company and something, because the scheme of demerger or merger do not give any detail. So I would say that in case of demerger, when a company is to be listed, a statement in lieu of prospectus must be filed before listing, so that investors have a clear idea of what is happening.
Okay. So that's one major aspect.
And one thing which I have again today I saw in the papers that Paytm will allow people to buy gold even at for 1 rupee. No, I am not sure who is going to be the regulator of this thing.
Okay.
Because is it a deposit which will be regulated by Reserve Bank of India, or it is going to be some sort of a collective investment scheme which will be regulated by SEBI. So I would request RBI or SEBI to step in right at the beginning, so that if before many people start with this scheme, there should be some regulation for this.
Regulatory clarity.
Yeah.
All right, Mr. Gupta. Thanks so much for sharing your thoughts with us on Mr. Tyagi's first board meet, and also on some of the aspects which perhaps the market regulator can look forward to. Hope Mr. Tyagi and his team are watching the show. And as always, thank you so much for joining me.
Thank you.
With that, it's a wrap on this edition of Amicus Curiae. Thanks so much for tuning in. This is Ashwin Mohan signing off. See you next week.
Find us on Facebook at facebook.com/etnow, and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/etnow.